Paul, you've published a deep dive into the growth opportunities for the alternative asset management industry. Whilst there are some near-term challenges, how do you see the sector's long-term growth opportunities?
Roger, we still see very strong growth opportunities for the long term for the sector, as you just mentioned. So we identified 5 key areas of where most growth can come from. One is a combination of the two, which is a private credit that's been very strong this year, and there's a lot of demand for it. The other is the insurance business, and in terms of captive insurances within large managers, and in terms of the insurance assets coming into the industry. So those two combined can provide over $20 billion of fees annually, 10, 15 years out. So there is a very strong opportunity for it. The other 3 themes which we think can be growing quite dramatically as well are in Asia, which is underrepresented in terms of private capital. Retail money coming into the industry, which is the market that's over $200 trillion in investor money that can potentially go into the industry. And lastly, the infrastructure and more kind of in terms of sustainable investments that a very strong kind of adoption phase in Europe and so on. So all of these can add incremental billions of fees to the managers, and the large managers are likely the most beneficiaries of that. Given that and said that, there is a lot of challenges right now that kind of temporarily slow down the cycle, even though there's still a lot of demand. Because of slower deal activity, and we've seen it in the M&A volumes, there is less money being put to exits and returned to the limited partners, to the investors, to be reinvested into the market. So there are some challenges. There are some challenges and concerns in terms of valuation, but long term, there is still very strong demand for the sector.
And Paul, why does size and diversity provide an edge in capital raising?
Well, first of all, some strategies fall out of favor in certain times versus the other strategies going out in other times. And for example, right now, the private equity business is a little bit more challenged, as I mentioned, in terms of deal activity, but the private credit is actually booming because there is a lot of need for financing, and in many cases for refinancing. There is some concern for the banks stepping away and the private credit managers walking into that space. Private credit is also floating rates, so when the rates going up, they actually make more money. So if you're a balanced manager and you have the credit and the equity and possibly even real estate that is having some challenges right now, you can work through different parts of the cycle. That's number one. Number two, when you're trying to raise money from retail or from large institutional investors, big diversified names and kind of one-stop shops in many cases are very beneficial to raising money.
And do you see the threat of SEC disclosure rules being implemented in 2024 disrupting the growth outlook?
Probably not. So working with our litigation analysts and our policy analysts, we don't see, first of all, we don't see it being implemented that soon, very likely at all. It could get implemented in some sort of form over time. But what I would say the large managers that we cover at Bloomberg Intelligence, the publicly traded managers, they already disclose a lot of that, and they already spend a lot on the reporting and so on. So it might add to a little bit to transparency, but it's probably not a large threat to the large managers in terms of additional costs. It might be more of a burden for smaller managers.
Thank you, Paul.